Welcome to the Deep Dive. Today, we're taking on a stack of fascinating market news items. For those of you looking for, a shortcut to being well-informed about the financial world, you're definitely in the right place. Our mission in this deep dive is to really pull out the most important nuggets of knowledge from these recent developments, giving you those aha moments without the usual information overload.
Indeed, yeah. We've got a range of intriguing reports today, covering everything from banking reforms to global defense spending, and even a major ice cream deal. We'll go through each development one by one, sort of highlight what's truly significant and what it might mean for the broader landscape.
Okay, let's unpack this then. First up, we're diving into the banking sector. It's been making some serious waves lately. Indian banking stocks are just on a winning streak, hitting new record highs. We're talking strong gains in major private players like HDFC Bank, Axis Bank, ICICI Bank, pushing the Nifty Bank Index to a new peak, 57,076 on June 26th. That surpassed its June 9th high. So what's driving this surge?
Well, what's fascinating here is the combination of factors. You've got favorable global cues, right?
Yeah.
Specifically, the Israel-Iran truce seems to have significantly improved risk-on sentiment for the Indian stock market. But the big story, I think, is the Reserve Bank of India's recent liquidity measures. They've relaxed project finance regulations. That makes lending more affordable for infrastructure and industrial projects, big ones.
Right. So the RBI is basically making it easier for banks to lend money out.
Exactly, yeah. The draft guidelines, the initial ones, they proposed sharply higher provisioning requirements, up to 5% during construction. That's a lot of capital to set aside. However, the final norms are far more lenient. They've set provisioning at 1.25% for commercial real estate and just 1.00% for residential and other exposures during construction. This is actually part of a broader set of easing steps by the RBI. There's relaxation for gold loans, the liquidity coverage ratio, the LCR, and they even deferred the expected credit loss, or ECL, implementation.
They've also been adjusting interest rates, right? I remember hearing about that.
Yes, definitely. The central bank's commitment is really underscored by some aggressive rate actions. We saw a 50 basis point cut in the repo rate and a 100 basis point reduction in the cash reserve ratio, the CRR. That was during the June 2025 MPC meeting. Pretty significant moves.
Okay, so it sounds like they're pulling at all the stops to boost lending. But despite all these efforts, what does the latest data on credit growth actually tell us? Is it working?
That's the interesting part. Despite these measures, actual credit growth, well, it remains subdued. As of end May 2025, it stood at 9.0% year on year. That's the lowest level since March 2022, actually. And year-to-date growth is a pretty modest 0.2%. Compare that to 2.1% during the same period last year. So yeah, a bit of a disconnect there.
So what does this all mean for the Bank Nifty's outlook then? It's hitting highs, but the underlying growth seems sluggish.
Well, Bajaj Broking, for example, suggests the Bank Nifty is likely to scale up towards the 57,600 mark in the coming weeks. They see it supported by a bullish technical structure, and the daily 14-period RSI is in an uptrend. They also see strong structural support around the 54,500, 54,000 zone. So technically it looks strong, even with that credit growth question mark lingering.
Okay, let's shift gears then. From banking to telecom. Bharti Airtel shares have hit a new record high. They crossed the rupees 2,000 mark for the first time on June 26th, reaching rupees 2,009 per share. Market cap soared to rupees 11.5 lakh crore. That's a really significant rally, especially considering the broader market has been a bit volatile, hasn't it?
Oh, absolutely. And here's where it gets really interesting. Bharti Airtel has gained 27% in under 4 months. It's solidifying its position as, well, a top turnaround champion of 2025. Brokerage firms are quite bullish too. Jefferies reiterated its buy rating. Target price of rupees 2,370, and they cited 4 key reasons to own the stock.
4 key reasons. Okay, tell us more. What are they seeing?
Right. So first, they see it as basically the best way to play India's ongoing consumption story, a proxy for consumer spending growth. Second, there's a significant runway for mid-teens revenue growth. Lots of potential there. Third, capital expenditure intensity. How much they need to spend, that structurally declined.
Yeah.
That improves cash flows and return ratios. Big plus. And finally, its valuations, they argue, have significant scope for re-rating, meaning the market might value it higher. Macquarie also retains a bullish outlook. They raised their target price to rupees 2,050 and even included Airtel in their India Super Sixes list. So strong conviction there.
Okay. Beyond the current financials, what's a big picture for Airtel's future growth? What's the next big thing?
Yeah, that raises the important question. What's next, right? The company is really set to benefit hugely from rising 5G adoption. There's a report from Ericsson estimating India's 5G user base will grow over threefold to around 98 crore by 2030. That's up from 290 million at the end of 2024. And conversely, 4G users are expected to decline pretty significantly.
So 5G is going to be the major driver then, a game changer.
Absolutely, yeah. India's 5G journey is scaling rapidly. It's fueled by, well, surging data demand, extensive mid-band spectrum coverage, rapid 5G smartphone adoption, and these large-scale 5G FWA fixed wireless access deployments. This creates a very favorable industry dynamic for a company like Airtel, really solidifies their position.
Okay, let's shift gears again this time to the primary market.
Yeah.
The HDB Financial Services IPO is underway. That's the NBFC arm of HDFC Bank. It's a pretty significant offering. A fresh issue of rupees 2,500 crore and an offer for sale, an OFS, of rupees 10,000 crore from HDFC Bank itself. The price band is set between rupees 700 to rupees 740 per share. What's the initial reaction been?
Well, as of the end of day 2 of public bidding, that was June 26th, the IPO was subscribed 1.16 times overall. If we connect this to the bigger picture, I mean, it indicates healthy demand, but perhaps not, overwhelming demand like we sometimes see. Maybe a bit more cautious.
Right. How did the different investor segments respond? Was it mostly institutions or did retail jump in?
The non-institutional investors, the NIIs, they led the way with 2.29 times subscription. Qualified institutional buyers, QIBs, they subscribed 90% of their portion, and retail investors subscribed about 64% of theirs. Interestingly, the company had already raised rupees 3,369 crore from marquee anchor investors before the public issue even opened. That usually provides some stability.
What about the gray market premium, the GMP? That often gives us a little peek into listing expectations, doesn't it?
It does, yeah. What's fascinating here is the GMP for the HDB Financial Services IPO. As of June 26th, it stood at rupees 60 per share. That's actually an increase from rupees 50.5 the day before, June 25th. So with the upper price band at rupees 740, the shares are sort of expected, unofficially, to list around rupees 800. That implies a listing premium of about 8.11%. Not huge, but positive.
Look, next up, let's look at a sector that's really picked up steam.
Yeah.
Defense stocks. Companies like Data Patterns, HAL, BEL, Zen Technologies. They rallied up to 4% on June 26th. This surge is apparently due to expectations of increased export orders. What's the connection here? Why the sudden buzz?
Yeah, that raises the important question. Why now? What's changed? The upbeat sentiment seems to follow a major declaration from NATO leaders at the Hague summit. Member states reaffirmed their commitment to collective defense and, crucially, pledged to invest up to 5% of their GDP annually in defense and security by 2035. That includes a minimum of 3.5% for core defense capabilities and up to 1.5% for critical infrastructure protection. That's a huge potential increase in spending.
Wow, 5% of GDP. That's a significant hike for NATO members. So how does this translate into opportunities for Indian defense manufacturers?
Well, if NATO members really do raise spending to 5% of GDP, it could significantly reshape global defense procurement dynamics. It just has to. And for India, with its lower production costs and improving indigenous capabilities, this presents a real strategic opportunity. They could emerge as an attractive secondary supplier for NATO countries.
A secondary supplier, okay.
Yeah.
What kind of products are we actually talking about here?
India already supplies a pretty wide range, everything from arms and ammunition to complete weapon systems like the BrahMos missile, artillery guns, the Dornier 228 aircraft, radars, armored vehicles. The U.S. and France are already significant markets for Indian defense exports, believe it or not. Plus, you have the Indian government's policy push. They're aiming for rupees 50,000 crore in defense exports by FY29. So there's ambition there, too.
So with all that potential, which Indian companies are, best positioned to benefit from this?
Analysts have highlighted several potential beneficiaries. Bharat Electronics, BL, is a key one. They specialize in radar systems, electronic warfare. Then you have Hindustan Aeronautics, HAL, Bharat Dynamics, BDL, and niche players like Data Patterns India in defense electronics. And private players are stepping up too. Bharat Forge, for instance, they've exported 155mm artillery guns to a European country, and they sign an LOI to supply howitzers to the U.S. Army. That marks India's entry into NATO-aligned heavy weapons markets, which is a big deal. But, it's important to remember this is a long-term opportunity. Export orders take time, involve lengthy processes, not overnight success.
Right. Good point. Okay, let's zoom out now to the broader Indian markets. They closed with strong gains for the third day straight on June 26th. The Nifty index not only crossed that psychological 25,500 mark, but stayed above it. Registered its highest daily close since October 2024. That sounds like a pretty significant shift, doesn't it?
It really does. What's fascinating here, technically speaking, is that market experts say the benchmark index finally broke out of a 31-day consolidation range, right on the June monthly expiry day. On the daily chart, it formed a sizable bullish candle. That reinforces the strength of the breakout. And the daily relative strength index, the RSI, also broke out of a symmetrical triangle pattern that indicates a surge in bullish momentum, so technically a clear signal.
Okay. Which stocks and sectors were leading the charge in this breakout, and which ones were lagging behind?
Well, among the index constituents, Shriram Finance, Jio Financial Services, and Bajaj Finance were the top gainers. On the other side, Dr. Reddy's and Tech Mahindra were the major losers. Sectorally, Nifty Metal, Nifty Oil and Gas, and Nifty Financial Services outperformed, but Nifty Media and Nifty Realty actually closed in the red.
Interesting. So strong performance in the main indices, but was it broad-based? Did the smaller stocks join in?
Interestingly, no, not really. Despite the strong performance in the frontline indices, the broader markets underperformed. Both Nifty Midcap 100 and Nifty Smallcap 100 showed pretty subdued movement. That reflects selective participation. The advanced decline ratio remained flat too, suggesting the rally lacked that broad-based support across the wider market. Investors seem quite focused.
And what about the institutional investor activity, the FIIs and DIIs? What were they doing?
Right. Foreign institutional investors, the FIIs, they continued to pair holdings, partly due to that narrowing yield spread between U.S. and Indian 10-year bonds we talked about. Less attractive relatively. However, domestic institutional investors, DIIs, they emerged as net buyers. They seem buoyed by improving liquidity conditions and maybe a rebound in domestic consumption. And the apparent stability, the ceasefire in the Middle East, probably underpinned investor confidence as well. That shift from FII to DII buying is a key theme.
Okay. Speaking of market movers, Jio Financial Services, JFSL, shares jumped 3% on June 26th, hit a 6-month high of rupees 312 per share. What's behind this latest rally for them?
This move comes right after the company announced a capital infusion. Rupees 190 crore into its payments banking arm, Jio Payments Bank Ltd. JFSL was allotted 19 crore equity shares of rupees 10 each in what is now its wholly owned subsidiary. So more investment there.
And this isn't the first recent move related to Jio Payments Bank, is it? They seem to be consolidating control.
That's exactly right. Just last week, JFSL acquired the remaining 17.8% stake, that's about 7.91 crore shares, held by the State Bank of India in Jio Payments Bank. They paid rupees 104.54 crore for it. This acquisition made Jio Payments Bank a wholly owned subsidiary of JFSL. Full control now.
So just to clarify for everyone, what exactly is Jio Financial Services? What are its key operations? What's the play here?
Right. If we connect this to the bigger picture, JFSL, which used to be Reliance Strategic Investments Limited, operates as a non-deposit-taking NBFC. Its specialties are things like retail lending, merchant lending, those payments bank operations, payment solutions, and insurance broking. It's building out a whole financial ecosystem.
And they've been quite active recently with other new ventures too, haven't they, beyond the bank?
Oh, yes. Very active. Jio BlackRock, that's their 50-point FIVZI joint venture with the global giant BlackRock, they introduced Aladdin. It's a unique investment analytics and risk management platform. Furthermore, Jio BlackRock Mutual Fund got SEBI's approval in late May to start operations as an investment manager for its mutual fund business in India. And Jio BlackRock Investment Advisors also got SEBI approval to operate as an investment advisor just on June 11th. So they're rapidly building out their financial services offerings. It's quite ambitious.
Okay. Moving from financials to something maybe a little sweeter ice cream. Big news about Magnum Ice Cream Company acquiring Kwality Wall's shares from the Unilever Group. What's the scoop here?
The scoop indeed. Well, what's fascinating here is the strategic move. The Magnum Ice Cream Company, or Magnum Holdco, is set to acquire 61.9% of the issued and paid-up capital of Kwality Walls India Limited, that's KWAL, from the Unilever Group. Magnum Holdco will also have to make an open offer to the public shareholders of KWAL following SEBI regulations for takeovers.
Why is this happening now? Was this something that was planned for a while?
Yeah, this raises the question, what prompted this move? The backstory is actually quite important. Unilever's India subsidiary, Hindustan Unilever, or HUL, announced back in January that it would demerge its ice cream business into an independent entity, which is KWAL. As part of that, HUL shareholders received shares of the new ice cream entity in a 1.1 ratio. So this acquisition follows that demerger.
Right. And why did HUL decide to demerge the ice cream business in the first place? What was the logic there?
Well, the company's board approved the demerger back in November 2024. They noted that the ice cream business, which includes brands like Kwality Walls, Cornetto, Magnum, it has a very unique operating model. It requires specialized cold chain infrastructure, distinct distribution channels, quite separate from the rest of HUL's operations like soaps and detergents. So the insight here is it's about focus. Separating it allows that business to operate more efficiently with its specific needs. And this aligns with a broader decision by the global Unilever Group last March to spin off its entire global ice cream business into a standalone entity. Streamlining.
Makes sense. Okay, from ice cream to chocolates and instant noodles, Nestle India has made a pretty significant announcement for its shareholders, its first ever bonus share issue. What are the details?
That's right. The board of Nestle India recommended a bonus share issue in a 1.1 ratio. This means for every one fully paid up equity share of face value rupees 1 that a shareholder holds, they'll receive one additional bonus equity share, also face value rupees 1. They're doing this by capitalizing a sum not exceeding rupees 96.41 crore from the company's retained earnings, basically converting profits into shares. The record date, which determines who gets the bonus shares, hasn't been announced yet.
Okay, so a bonus issue means more shares for existing shareholders that don't have to buy more. Have they rewarded investors in other ways recently? Or is this the main thing?
No, they have. Earlier this year, Nestle India had recommended paying a final dividend of rupees 10 per equity share for the fiscal year 2024-2025. And following this bonus share announcement on June 26th, Nestle India's shares saw a nice little increase, over 1%, hitting an intraday high of rupees 2444.65. So positive market reaction.
Okay, finally, let's look at a rather dramatic development in the global energy sector. Big news. Big potential deal. Reports surfaced on June 25th that oil and gas giant Shell was in discussions to acquire its rival, BP. This would have been the largest corporate deal this year. Huge implications.
Oh, indeed. The Wall Street Journal reported that both these British oil majors were in active talks and that BP was, quote, considering the approach carefully. Such a deal would have put Shell in a really solid position compared to even larger rivals like ExxonMobil and Chevron. You saw BP shares initially jump as much as 10% in New York on this news. A lot of excitement.
The story quickly changed, didn't it? That excitement didn't last long.
It certainly did not. A Shell spokesperson very swiftly denied the WSJ report, stating, quote, this is further market speculation. No talks are taking place, end quote. Consequently, BP's shares erased most of those gains almost immediately, a very quick reversal.
What's the background to these rumors, then? It feels like BP is often mentioned in takeover talk.
Yeah, this raises an important question about market speculation, doesn't it? BP, currently valued around $80 billion, has been under intense pressure. Years of underperformance, intervention from activist shareholder Elliott Investment Management. There has been growing speculation that the London-based company could become a takeover target just because of that pressure and maybe its valuation. In fact, Bloomberg had reported back in May that Shell had actually been studying the merits of a potential deal. So the idea wasn't completely out of the blue. A successful combination of Shell and BP, once incredibly close rivals, would have been one of the oil industry's largest ever takeovers. It's a topic that's been discussed sort of on and off for decades, really. So the rumors might be denied now, but the underlying pressure on BP remains.
Wow, what a deep dive. We've really unpacked a lot today. Everything from central bank policies influencing banking stocks to telecom's massive 5G future, IPO dynamics, those global defense opportunities, broader market movements, corporate acquisitions like Magnum and Kwality Walls, bonus share issues from Nestle, and even that Shell BP rumor mill.
Yeah, if we connect this all to the bigger picture, what really stands out is how seemingly disparate pieces of market news, whether it's a central bank's liquidity measure, a geopolitical truce, or a corporate demerger, they all contribute to shaping market sentiment. And they offer insights into those underlying economic trends. Understanding these individual developments really helps build a more complete picture of how the financial world actually functions.
Exactly. We hope this deep dive has given you a clearer, maybe more insightful understanding of these recent developments. It's definitely a lot to take in, but breaking it down nugget by nugget, hopefully, makes it more digestible.
As always, our goal is just to help you be well informed. Thank you for joining us on the deep dive.
And one final, very important note. We are not SEBI-registered financial advisors. If you are considering making any investment decisions based on anything you heard today, please consult a certified financial advisor first.